What if your mortgage worked for you rather than against you? That's exactly what the all-in-one loan is and why real estate investors are using it and taking notice. It's not just real estate investors. Be on the lookout for future videos about upsizing and downsizing and how this can benefit you. But stick around for the first part, at least, if you're not a real estate investor, to find out how this loan can work for you. And also, if you're looking into being a real estate investor, this may just be the product to allow you that freedom to invest. I'm Brandon Faber. I am a West Michigan realtor, and I personally use the all-in-one loan product on our primary residence and will be future using it for our investment properties. So stick around to this video. Would love to share it with you. At its core, the all-in-one loan, or AIO, is a first lien HELOC, or home equity line of credit. That means it replaces your traditional mortgage. Here's the kicker: your income deposits directly into the loan account, all in one, acting as your primary checking account. Every dollar you deposit reduces that principal of balance immediately. Interest is calculated daily, not monthly, on the remaining balance, so the more money you have sitting in the account, the less interest you pay. Unlike a 30-year traditional fixed loan, which has a rigid amortization schedule, the AIO loan is flexible, and that flexibility is what makes it so powerful to those who use it. And we're going to talk specifically about real estate investors. Let's say you're an investor with a rental portfolio, or maybe you're flipping homes. With a traditional mortgage, you're stuck. Your equity is locked unless you refinance and get a HELOC, which would be a second place HELOC. And accessing that money through the HELOC takes time, some extra closing costs, and of course, that underwriting piece every time you want to get a HELOC on one of these properties. With the AIO loan, you have daily access to most of that equity you built, and it's like a line of credit. You use it like a checking account, like I said before. You can pull cash for a down payment or repairs or new deals or some downtime between tenants. And with margins as tight as they are for the typical real estate transaction these days, especially for investors, not having to pull from other accounts for capital expenses is huge. So you can recycle that capital without needing to refinance or take on new debt. Now, it's important to note, when you do take money out of that account, you are increasing the balance owed. But like I said before, each deposit, so you get your monthly payments, whether that be your income or the income from the rentals, will reduce that principal balance. Let's talk through an example. Let's say you have a $500,000 property, you owe $300,000. The AIO gives you access to most of that equity as needed. It's important to note that the equity access will be reduced after year 10 if you're using a 30-year model by 1/240th each month until year 30. However, nothing says you can't refinance into a new AIO loan after year 10, with the understanding that historically not only have rents increased, but also the property value should have increased as well. Obviously, can't make any guarantees on either one of those scenarios, but historically, that's what's been happening. So here's some uses for this. If you are doing the BRRRR strategy, so it's buy, rehab, rent, refinance, repeat, use the AIO to fund the rehab, then roll the rental income into the loan to reduce the interest. If you're doing a fix and flip, obviously you'll have fast access to the capital for materials and also closing costs. And for short-term rentals, you can use that seasonal income to aggressively reduce the balance in the high months and then draw from the funds in the low months. What about the pros and cons to this? Well, it has unmatched liquidity for equity in properties. Secondly, its interest savings is strong with strong cash flow. And you have one account for income, bills, and the mortgage. What are the cons? Well, it requires consistent income and strong budgeting. You can't be loosey-goosey with this. It has a higher variable interest rate in some cases, and it's not ideal for passive or fixed income earners that may not be great at budgeting. So if you're an investor or you're someone that's looking to move up into a property and you want some more flexibility and control, this might be your next smart move. So make sure you reach out to me. I'd love to run the numbers with you and introduce you to my AIO loan expert. So grab one of those links below, comment below. Would you use this as an investment strategy? Would love to hear from you. See you at the next video.